Now let's talk about investment in real estate and working with real estate investors. And matter of fact, real estate professionals who are working with buyers and sellers will a lot of times be involved with all three of the areas that real estate investors will invest. First of all, the investment is the acquisition, and that's buying the property. And a lot of times, the real estate professional will be involved with that. And then during the holding period, that's where a property manager comes in, and the investor is looking for rental income from the acquisition to the disposition. And then at disposition, that's when the property is sold, and the investor will get their capital back with hopefully some increase in value, which will be called price appreciation. So all three of these periods, the real estate professionals are end up being involved with all three of them. And as it says on the slide, real estate investors generally have different alternatives than owner-occupied home buyers or homeowners. They can buy and sell not based upon their own home and where they live, but strictly by market timing. And what this means is that if you have your own home and the real estate owner-occupied single-family residential market is moving up and down, you really are going to have a difficult time selling when the market is up, because then where are you going to go to live? Whereas investors, they already have their home, and then they're buying these single-family homes as rental properties. And then as the market goes up, if an upward trending seller's market hits near the top, they'll go ahead and sell, which is the disposition phase. And they may either cash out and take their money and pay the capital gains to the IRS, or they could also do a 1031 tax deferred exchange into another property somewhere that maybe hasn't already peaked, and then move it around. Or they may move it into newer properties in better neighborhoods because of less loss in value as the property heads down to a downward trending buyer's market. So when working with real estate investors, real estate professionals are going to be involved with every aspect of that. And then what happens, we have a freehold estate and a leasehold estate. And a freehold estate, that's the highest form of ownership, and it's considered real property. And this is what a person who bought, let's say an investor bought a single-family home as an investment, that single-family home investor would own the freehold estate, which of course is real property. That means they own the land, the building, and all the appurtenances which run with the land. Now, if that investor leases the property to a tenant, and then what happens is he's giving the tenant a leasehold estate. So the single family home has both freehold and leasehold estates in it, but you can give the leasehold estate away to a tenant, of course, in return for rent that they're going to be paying. And that's just a possessory interest, and it's considered personal property. And this is, in fact, where most investors, real estate, really make their money, because by being able to give this leasehold estate to another person in return for rent, you can retain all the ownership of the property, but you can give possession for a very short period of time to that tenant in return for rent. And both of them are estates in land, which is ownership interest in land. The freehold estate, of course, is the best one, because that's where you own the land, the building, and all the appurtenances run with the land. And of course, leasehold estate is not a real good estate. It's just for a short period of time, but they both are considered estates in land. And they, of course, are very important to the real estate investors. An owner of a real property must be able to break up a property's freehold and leasehold estates. Just like we mentioned, you'll want to be able to do that. And then when an owner rents out a property to a tenant, the owner is giving possession for a short period of time called a leasehold estate. So the tenant is exchanged for the tenant paying rent to the owner. Let's talk about single-family homes. And single-family homes tend to be the most desirable property type for tenants. Tenants typically like single-family homes the best over apartment buildings and over, townhouses, condominiums of that nature. They like those single-family homes the best, so they will produce the most amount of rent. Financial analysis can be accomplished through the investigation of sales comparables and rental comparables. So an investor, what they'll do is they'll figure out what the value of a single-family home is based on sales comparables of properties that have sold in the area. Now, the interesting thing about single-family homes is that they have two different uses, and you can go back and forth between the uses. One use is for an owner-occupied homeowner to buy it and live there. And of course, they would have the freehold and they'd have a leasehold. They haven't given any leasehold estate out on that, so they have all the rights on that property. And the other one is that a single family home can also be a rental property. So the owner could actually bring a tenant in, give the tenant that leasehold estate in return for rent, and then they would own the freehold estate. The investor would own the freehold estate, whereas the tenant would have the leasehold estate. And so you have two different types of uses on that. And for that reason, what a lot of times investors will do is they'll buy a property near the bottom of a downward trending buyer's market when none of the owner-occupied buyers want the property. They're a lot of times upside down where the loan's worth more than the value of the property. And then what they'll do is they'll do a short sale, or it could even become a foreclosure property. And then the investor will come in and buy that property for really, really cheap. And then what they'll do is they'll rent it out to a tenant all the way up through the upward trending seller's market till near the top of the upward trending seller's market. And then they'll sell the single family home to an owner-occupied investor who will pay the most money for that property. And the reason for that is because they can get a low down payment, high loan to value loan from FHA or from Fannie Mae, and they'll pay the most money for that property. So when the investor is selling the property, they're probably going to sell it to an owner-occupied buyer. So when you do a sales comparable analysis, you're going to do that and find properties that have sold as recently as possible, with the same type, size, and same style, architectural style, and also amenities that the subject property has, and then come up with a value for the subject property. And those are called sales comparables or sales comps, and that's a sales comparable analysis that you use. So we use that for single family homes, ones that are selling. Now, rental comparables, what they are is if we have, let's say an apartment building, a 10-unit apartment building, and our client has bought it, let's say, and we're going to figure out what the rents are. Well, we would look at the competing apartment buildings around the subject property and find out what are they charging for rent. And whatever that range is that they're charging is probably the rental range that you'll be able to charge for that particular apartment building. The reason this is important is because a buyer comes in and buys it, and if the rents are below market rents, which we can find out through a rental comparable analysis, looking at the rent comps, then the investor knows that they can, once they come in, they can go ahead and raise the rents. A lot of times that's done in a slow basis until it gets up to market rents. And a real estate investor may base investment decisions on projected appreciation in a particular geographic area and not on projected increases in income derived from increased rent. So what happens is that a single-family home gives you a little bit of an advantage because, again, you're using with two different uses. One of them is going to be as a rental property, and the other one's going to be for owner-occupied use. Okay, so what happens is that you're looking at what is that single family home going to be worth in the future as an owner-occupied home, even though you're renting it out to a tenant right now. You're going to be selling it to an owner-occupied buyer, and what is it going to be worth in the future? And a lot of times it's a lot more than if you just had, say, an apartment building. All you'd be basing yours is on the amount of rents that they have. So this way, this gives you a little bit more of an upside as an investor, being able to change the use from an income property, which is a rental, and then to owner-occupied, and then back and forth. And that's how you can make a lot of money in the real estate business. A real estate investor is also looking at particular geographic areas, because in the better areas typically will have the highest price appreciation, which is increase in value, whereas the lower socioeconomic areas will have a lot less price appreciation. And also when you get into a downward trending buyer's market, those really nice areas will go down slower than those lower socioeconomic areas. So they're typically a good place to be. The problem with that is it's hard to make them cash flow because a lot of times the prices are too high to be able to make them cash flow as an investment. So there's a fine line there between the two of them. And when an owner-occupied homeowner decides to purchase a new home and rent their present home to a tenant, they may be able to use part of the rental income for the existing home to qualify for a loan on the new home. So what happens is, let's say that your buyer goes in and buys an owner-occupied home with FHA financing with really small down payment, high loan-to-value type loan. And then they live there for a while, and they, instead of selling it, they want to rent it out and then buy another property. So what they could possibly do is, if they can rent that existing home out to a tenant, changing the use from owner occupied to to a rental, and then buy another home and move into that one. The lender, as long as they're buying up in value, may allow them to do that, and they'll take some of the rental income from the money that's now being earned from the existing home and apply that to qualification on the new home. So that's something that you'll look at for owner-occupied buyers. Now, something that happens with high loan-to-value loans, which is a very small down payment, is something called private mortgage insurance. And a homeowner may have paid as little as 5% down payment and finance the remaining 95%. The problem that lenders run into is that they don't like to make loans above an 80% maximum loan-to-value ratio. And the first person buying the property, whether it's an investor or it could be an owner-occupant buying at the end of the investor's holding period, what happens is that they only have 5% down. So if they have pretty good credit, then they may be able to get something called private mortgage insurance. And if an owner-occupied borrower has an exceptionally good credit rating and stable income, a private mortgage insurance called Pmi company may step in and insure the 15% the lender does not want to loan. What that means is that if there's a foreclosure, then the lender will get their 80% back, and then the 15% above that, the private mortgage insurance company would be on the hook to pay the lender for the loss. The lender would only incur any losses below 80% loan to value. So these can be used along with the FHA loans, and this is something that there's a lot of times is used for conventional loans that you would get. Maybe that second one you did when you bought a house and you rent out your existing one. Okay, this is used for conventional loans. Okay, and Pmi covered loans are generally used for owner-occupied single-family home loans. Pmi companies are generally active during upward trending sellers markets. The reason is the properties are going up, so their 15% that they're at risk on a loan will diminish as the price goes up. Now, when the price is going down, values are going down, the Pmi companies are typically nowhere to be found because they know that they're going to be paying out a lot of money for losses. So that's usually how it works with owner-occupied single-family markets. And a loan with Pmi insurance will allow the owner to lose their 5% down payment. The lender may actually come out okay, as the Pmi company must pay for the lender's loss, which is up to 15% of the loan amount. Now let's look at example number one with wealth building. This is just an example that show you some ideas as in terms of what investors look for. Say you have a husband and wife, they purchase a $110,000 single-family home in Chico, California. Now we're using these numbers are fairly low here compared to the markets, but it's easy to understand when they're lower numbers. So that's why we use that number, okay? And so what happens is they buy the property for $110,000. The property purchase, they put 10% down payment, which is $11,000. Now, a lot of times the lenders, of course, want 20% down, but they may allow you to put 10% down, but you may have to bring some Pmi into that. Okay, so you have to pay a monthly premium and sometimes an upfront premium as well for the private mortgage insurance. You're going to get a $99,000 loan on the promissory note. All that is that's the evidence of your debt, right? Secured by a deed of trust and called a first trust deed. And we use a 7% fixed rate. It's pretty high, but it's a good one to look at. And then 30-year amortization schedule due in 30 years, meaning that person's going to, over 30 years, pay off this loan, the buyer. So the purchase price is $110,000. Now, what's the monthly payment going to be on that? Well, at that 7% fixed rate over 30 years, right, a $99,000 loan, it's going to have $658.65 principal and interest. And each payment that they make, the principal amount goes up and the interest goes down. The actual amount stays the same, but of that $658, each payment of that will be more principal and less interest. But the first payment's almost all interest and very little principal, whereas the 360th payment 30 years out will be almost all principal and very little interest. And of course, your finance videos to explain how amortization works. Then there's $92 in property taxes. Now, the property taxes will be between 1.15 and 1.25% of the value of the purchase price, called ad valorem according to value, is how that works. And so this will be $92 for our example. There's $30 a month in homeowners insurance, and that's going to be what you would have on this particular property. Since it's owner occupied, it would be a homeowner's policy, which covers fire, the contents inside the property, and liability for some liability possibly for the property owner. Now, as they become a rental property, you'll be changing, the clients will be changing the homeowner's insurance over to an owner tenant liability policy that is usually a little cheaper than the homeowner's policy, and it covers fire and liability, but it's as a rental property rather than homeowner's insurance is owner occupied. So you have to be kind of careful when you look at the insurance on those, and talk to an insurance agent looking for quotes, find out exactly how much it's going to be. They also could have something called a CLUE report, CLUE. So if the CLUE report has water damage and things in the past, there may be a high incidence of a claim being paid out, and you may have difficulty getting insurance. Also, if you're up in the Sierra Nevada or some of the other mountains in California, you could have a fire, could be a big risk, and you may have very difficult time finding homeowners insurance. So with your clients, you should investigate and make sure you can get homeowners insurance before the end of the physical inspection contingency period. And because if you can't get insurance for a reasonable price, probably don't want to buy the property. Then we have a $40 private mortgage insurance premium, PMI. And then we have a property management fee. And what happens is that the investor will pay a property management fee on a single-family home, probably around 10%, and up to huge apartment buildings might be down as low as 3%. You might get a deal on some multiple single-family might be down to 9 or 8%, and it really depends on the property management company. Some of them charge a lease-up fee to lease up the property, others don't. And so it's up to the property manager what they want to do on that, and then as an investor whether they want to pay that much or not. And so it's an $861.90, which is PITI, which means principal, interest, taxes, and insurance. On top of that, we're going to add private mortgage insurance and the property management fees. This is year one for this home in Chico, California. Now, the break-even analysis, this is the income you're going to get if you have this single-family home in Chico and you buy it, and what you're looking at, how much rents you're going to have to do to break even is when it comes down to. So let's say that you rent this out and you get $10,200 annual scheduled gross income. What that is, if you have a tenant, that tenant is paying $10,200 for a year in rent. And you divide that by 12, you get your monthly rent, what they're paying. So you got $10,200 now. There is no vacancy in our calculation. A lot of times we'll put a 5% vacancy in there on all of them just because of the potential for vacancy. We're not looking at that on this particular analysis, but with clients, investors are buying a property, they may expect that 5% to be in there. So your effective gross income is what you actually collect, and that's $10,200 in the example. And from that, you're going to subtract your operating expenses. And those operating expenses are going to be property taxes, which we mentioned was 1.15 to 1.25% of the sale price, $1,104. Property insurance, and that's $360 per year. And then we have private mortgage insurance, $480 per year. And management expenses are going to be $495 in the example. So the total operating expenses are $2,439. And gives us a net operating income of $7,761. Now, what that is, the net operating income, that's the return that your investor will get if they pay all cash for the property and there's no loan. Okay, so they'll make $7,761. However, in this example, right, the buyers of the property, they're going to get a loan, and what happens is they're paying $7,903 in annual debt service. Now, that does not take into account the principal reduction, because with each one of those 12 payments, there'll be a little bit of principal reduction on each payment to pay off the loan. We're not taking that into account, but it isn't very much. And again, you can see that in our financing video. That gives us our before-tax cash flow of $142, which is very close to a break-even cash flow. And then you're wondering, well, why in the world would they even want to rent this out at a break-even cash flow? And why would they want to rent it out? Well, they're moving to somewhere else, buying another house, and they want to leave this and keep this one here and then rent it out. Well, they're looking at price appreciation. Maybe the market's on an upward trending seller's market and make some money on price appreciation. When it gets near the market, they'll list it for sale and then sell the property and then take the capital gains on that. Okay, so that's one of the reasons. The other is because of depreciation. So the IRS allows real estate professionals to depreciate a property. And they do is they take the building portion, divide it by 27.5 years for all residential properties, and you get a depreciation, and you can use that against your taxes. So what it does, it's a little bit of an advantage. See a CPA, though, to find out how that works. We do cover that in our tax video as well. Now, in year 4, husband receives a promotion to San Fernando Valley. New value of the Chico home is $100,000. Loan is $99,000 less 4 years of principal reduction, which is not considered, which won't be very much. And the employer may step in and purchase the house from the husband and wife, sell it, pay the difference. In this case, there's a loss. Instead of going up in value, it went down. So the corporation may come in and actually buy the property, and the husbands and wife were on the way, to San Fernando Valley. The other alternative would be to turn the Chico home into a rental property, is what we were talking about in the previous slide. Okay, so when the husband and wife move to Southern California, they may have enough money for a down payment on a home. In addition, loan qualification may be enhanced, as the husband's new position probably pays more money, and the wage scale of the wife's job is much higher in Southern California. So what we're saying here is that the husband and wife, they can do two things. They can go ahead and just get rid of the property, have the corporation buy them out and get them down to Southern California and then deal with it. Or, of course, they could do a short sale on it if they want, which is a lot of work with no return on it. Or they could go ahead and rent it out, sit on it, and then wait for the market to come back up, because it may be near the bottom of a downward trending buyer's market and moving into an upward trending seller's market, and they can make some money on it as it moves up, and then down the road sell the property. So that's what they're doing on this example, is they're going to keep that one and then buy a new property in Southern California. Now in year 8, executive gets promoted again, this time to San Francisco. Cost of living was $100 in Chico. San Fernando was $130. San Francisco $235. Extremely expensive area where they're going. And now they have two houses. They bought the first one up in Chico, then they bought the second one down in San Fernando. That one was probably with a conventional loan and some PMI insurance. And now they're saying, well, you know what? We want to rent that one out in San Fernando as well. Now we'll have two rentals. We're going to go to San Francisco and buy our third property. Problem with that is they probably don't have enough down payment, income, or anything to be able to get anything in San Francisco. So they may have to try to get some financing if they can, as well as they can, because as long as they're buying up, the lender may allow them to buy that third home. And you can also start looking at the seller carry type loans there as well. Okay, so the husband and wife may be able to purchase their third home with owner-occupied financing. So now they have 3 homes. They're living in one, San Francisco, and they're renting out the one in San Fernando and the one in Chico. Year 12, the husband's promoted again, this time down to San Diego. National economy is peaking. It means that possibly the upward trending seller's market is doing well as in terms of price. Prices are going up. And husband and wife purchased their 4th home with a large down payment and seller carry loan, prevailing market rates. So now they have 3 rentals and they have their own home where they live. So in year 16, husband and wife's loans have started to amortize with significant principal reduction, and additional equity has built up through price appreciation in the home. So over those 16 years, the market's changed on all of those homes, and now they're all up in value. Plus, we paid off a lot of the, not a lot, but quite a bit of the principal of the loan. 16 years is a pretty long time, and you get quite a bit of principal reduction during that period of time. So they're pretty happy about that because they're amortizing them out and they've gone up in value. The husband and wife can acquire 10 homes over their career. They could have close to $1 million in equity. They reach 55. This is in addition to retirement accounts and other more passive securities investments. The strategy is not a walk in the park, however. Even with a professional property manager managing the property, husband and wife will still have to deal with headaches of being a landlord. What happens with that is you have things will start going out. Air conditioning will go out, heating will go out, HVAC, heating, ventilating, and air conditioning. They'll go out. The roof will need replacement. You may have hot water tanks that start going out on you, and you'll have to start replacing those. And just things. The house starts becoming dated, and so there's issues that go along with that. With year 16, you're out there. But the husband and wife will now own 4 properties and have quite a bit of equity. Now let's talk about example number 2. This is an inexpensive home located in a lower socioeconomic area, and this is an actual investor made these purchases, which is really interesting. They bought this property in 2010, and real estate investor paid $65,000 all cash to purchase 3-bedroom, 1-bath home located in Northern California. That property was selling for $350,000 in 2005. By 2010, it was selling for $65,000. So talk about a downward trending buyer's market. I mean, this was an REO, which is the bank had taken back. An investor had come in and had bought the property with all cash. And home rents for $1,000 per month, with rents projected to increase in the future as demand for single-family homes increases and supply stays the same. That property actually did go up to $1,300 a month over a period of time, but it was $1,000 a month is what the investor was getting at the time when they bought it. So the numbers, you got $65,000 purchase price, all cash. There was no loan on it. It provides $12,000 per year in rents, which is $1,000 per month. I think that house was built in the 1950s, so it's been around a long time. Now, to calculate your net operating income, what you do is you take your scheduled gross income, which of course that's how much rent you get if completely $1,000 a month times 12 months. We're not going to put any vacancy in this one because this was on a 12-month lease, and the tenants had been in there for quite a while, so we just left the vacancy out. But again, you want to put about 5% in there when you're selling a property to an investor, because they're going to expect that. Effective gross income is about $12,000. Less operating expenses, property taxes, we use 1.25% of the purchase price, $813. Insurance, in this case, an OL&T, owner liability and tenant policy, OLT. What happens with that? That's once used for investors and not an owner-occupied, but for investors. That's $425 per year. And then water, sewer, garbage is $125 per month, which is $1,500 per year. Now, sometimes landlords will not include that in the rent and make the tenant pay it separately. Other times they'll raise the rent up that much and then pay it themselves. And if you look down where the asterisk is, water, sewer, and garbage may become a lien on a property if the tenant does not pay the bill. And that's the biggest problem we run into, because if the tenant doesn't pay the bill, the landlord's going to have to pay it anyway. So a lot of times the landlord will collect it in the rent and then pay it to make sure it gets done. This means the landlord will be stuck paying this bill no matter what happens with the tenant. Some landlords pay the water, sewer, and garbage themselves instead of the rental amount, according to cover it. Water meter usage sometimes billed to the tenant, depending on how much water meters. Matter of fact, sometimes investors will cover that as well, as long as they don't go crazy on the water. It depends on where it is. Okay, so that's going to be your water, sewer, and garbage. Then you have maintenance on this, and that comes down to the age of the property. And this one was built in the 50s, so it's going to have a little bit more maintenance than newer properties will have. Matter of fact, your investor will be looking at that when they look at buying a property. Is it going to be something that they're going to have a lot of problems with, especially one built in the 50s, because that's, 50, 70, like 70-year-old house. A lot of times the sewer lateral, the sewer, they call it soil pipe on the, also, it will start deteriorating, so you have to replace it. Water lines will start deteriorating as well. And so there are some major things that could go wrong with that, versus a newer home may not have those types of issues. So the total expenses are going to be $3,738, and your net operating income is $8,262. And that's the return you get if you pay all cash for the property, just like this investor happened to do. And so the real estate investor's return is the capitalization rate when all cash is used to purchase the property. Okay, and I'll tell you what the capitalization rate is in just a second. Therefore, price times capitalization rate equals net operating income. In other words, capitalization rate is the return a real estate investor receives if all cash is paid to purchase the property. So it says V for value was $65,000, and he's getting $8,262 per year net operating income. So you can do a little bit of algebra here, or not. It's not. What happens is it's V times R equals I, or I divided V equals R. But what it comes down to is you're looking at what percent return is that investor going to get. Okay, and in this case, it's going to be 12.71%. And how you do that, you take the income, net operating income, and you divide it into the $65,000 sale price, and that's how you get it. And you can always check your work, remember, so you take the 65,000 times 12.71%, and it comes out to 82.62, then you got it right. 12.71 is a pretty good capitalization rate on that. Not fabulous, but pretty good during that period of time. And so in addition to a 12.71% return on the buyer's all-cash investment, buyer may also experience price appreciation, which is increase in value during the holding period. So the investor might go and buy the property, get a 12.71% return over the holding period, and then at disposition, sell it and then take the price appreciation. On top of that, the investor will also have some depreciation that was taken during the holding period, which will also help the investor as well. Now, small multi-unit residential properties, duplex, triplex, and fourplex. Let's talk about them versus single-family homes. And a duplex is a building that's comprised of two residential units located on one parcel of real property. What that means is that there have two units are both on one single parcel. You may see some of them that have a dividing line right in between so you have a half plex on one side, a half plex on the other side, and they're two different parcel numbers. And that's the case, then you're dealing with half plexes. But these are duplexes. You only have one assessor's parcel number for the entire property, which is the two units. And the owner can rent each of the units to a separate tenant, or occupy one of the units and rent the other unit to a tenant. And what that means is that you can move in there, and you can also get owner-occupied financing. So your clients may say, you want to go move in there, they can get owner-occupied financing even though they're only occupying one of the units. They can actually do that up to 4 units. Okay, so in this case, you would occupy one, rent the other one out, and you get owner-occupied financing, which is high loan-to-value, low down payment type financing. You can also, when you decide to buy another property, is you could actually then hold on to that and rent both sides out. Matter of fact, that's what a lot of times investors, new investors will do that. Instead of buying a house first time, they'll buy a duplex and then live in one until they can buy another property. Then they buy the other property and rent out the duplex. Now they have both sides of the duplex rented to tenants, and then they live in their new property. Triplex is 3 apartment units located in one building. It's like a duplex, but there's 3 units. And there, again, you can occupy one unit and rent the other 2 out and still get that owner-occupied financing. And then a fourplex, also called a quadruplex in some other markets, is 4 apartment units in one building where you would occupy one and rent 3 out. You can still get that owner-occupied financing. And again, you would go ahead and then when you buy another property to move into, you could rent that out and then have 4 tenants in that building. And when an owner lives in a one unit and rents the other units in duplex, triplex, or fourplex to tenants, owner may be eligible for owner-occupied financing for the entire property, even though part of the property is rented to tenants and producing income. Yeah, it works out like with FHA insured loans. It can be done. Some people don't like to move into a duplex, triplex, or fourplex because they don't want other people living, in their property that they're owning. But this is one way to generate wealth over the long term. And then we have large multi-unit residential properties, and these are apartment buildings of 5 or more units. They're described as large multi-unit residential properties and not generally used for owner-occupied use. And these, of course, will always be non-owner-occupied financing on these types of properties. And they're strictly income properties purchased for their income stream, price appreciation, because you'll get that when rents go up, average average leverage, where you can leverage the property, and if you can put a down payment of say 25% down, and you can borrow 75%, you can actually use leverage to increase your returns. And then depreciation, which of course is for tax purposes. This is a paperwork loss the IRS lets you take on the property, and that's covered in our tax video. Now let's give an example of this apartment building, a large apartment building, 32 units, 1.195, 315,000 down. Prices are real low on this on purpose, just to make it look easy, okay? Scheduled gross income, 155,000, 196, less vacancy. We're actually putting vacancy in on this, around 5%. And effective gross income, 147, 436. That's what you actually collect on the apartment building. Less expenses. We use 35% of the effective gross income. For large apartment buildings, you can use them, and they'll run a lot of times anywhere from about 29 up to about 40%, depending on the property. A newer property might go down as low as 29, but the older ones are going to be at 35, even 40% of the effective gross incomes are going to be the expenses on those. And we mentioned what those are earlier. We have the fixed and variable ones. We have the property taxes, insurance. Then we have any types of variable expenses, water, sewer, garbage, things like that. And then we have net operating income, which is $92,016. That's the income the investor would receive if they paid $1.195,000 all cash and don't get a loan. In this case, of course, we're getting a loan and putting $315,000 down. So our debt service on this one is going to be $81,149. And so our before tax cash flow is going to be $10,867, which isn't very good, really, for that much money of the cash flow you're getting. So hopefully they got some upside on the rents. Down payment. The larger the down payment, the more comfortable the lender is making a loan on the property, because then if they have to foreclose, they got a better chance of getting their money back. In our example, the down payment is $315,000, which is 26% down, and so the normal for that type of property is about a 74% loan-to-value ratio, which is pretty good, about normal for something like that. Then with apartment buildings, we have something called a gross rent multiplier, or GRM. Scheduled gross income, right, divided into the sale price, gives you your gross rent multiplier, which is going to be typically on an annual basis for apartment buildings. Now, for single-family homes, they may use a monthly gross rent multiplier because that's what real estate appraisers use. But as real estate professionals, we typically don't use the monthly gross rent multiplier, but we do use an annual gross rent multiplier for apartment buildings. And the scheduled gross income, divided into that sale price, right? And the scheduled gross income is the amount of income property will produce in a year if all units are rented. No vacancy for the entire year, and remember, you may have some vacancy. That will, of course, reduce that your effective gross income down. But in this case, you just take your SGI and divide it into the the price of the property, and that'll give you your GRM, or what they call times the gross out there in the market. It's the same thing. So our example, it's going to be 1.195 divided by 115,000, about 7.7 GRM or times the gross, which isn't too bad in the recent markets. Years ago it was a little higher, but now the recent markets we have now that's probably pretty decent. Now, when you get a loan on a multi-unit residential property, one of those large ones like that, it's a commercial variable interest rate loan and fixed rate loans. A lot of times they won't do variable rate loans because then if the interest rates go up, the lender can participate in that. Whereas fixed rate loans, interest rates go up, you don't get any of that. Participation in the increase in the market. So that's why I like the variable rate loans. They call these adjustable rate arms in the single family market, and the commercial variable rate loans in the commercial market. And in commercial, they use something called a debt coverage ratio, DCR. And what happens is, before funding a loan for a multi-unit residential property, lenders calculate the debt coverage ratio, DCR, to ensure the net operating income covers the borrower's debt service, which of course is their loan payments. And I'll show you how it's calculated. Look down below that. DCR is calculated as the annual net operating income divided into the annual debt service. So the 92,016 net operating income that we just looked at, we divide that into the 81,149 debt service, and that's a 1.13 to 1 debt coverage ratio. And that's actually pretty good. So the debt coverage ratio, DCR, is required by lenders and varies by property type, riskiness of the investment, down payment, and points charged for the loan. Apartment buildings may have a 1 to 1.05 or so, that range, or higher, whereas commercial leased investments might have 1.10 or higher debt coverage ratios, meaning they're going to want a higher net operating income so that you have more money to pay the debt service for the riskier type investments, which would be usually the commercial investments, because if you have a tenant that leaves or goes out of business, you're going to have to re-rent it up, pay leasing commissions. You got tenant improvements, they call those TIs, where you have to do a lot of work on the inside of the property to get it rented back up. So it can be very dangerous situation for lenders, because if they have that situation, they may have to foreclose and they can lose a lot of money. Now, our operating expenses, what they are is they entail fixed and variable expenses. And this would be for both apartment buildings, small duplexes, triplexes, fourplexes, single family, rental properties. All of them will use this. So we have fixed expenses, which are they do not change each month, like property taxes and property insurance. You pay those taxes twice a year here in California, and once a year you pay the property insurance. Whereas variable expenses, they're not consistent, may change each month. Water, sewer, garbage, maintenance, management, things could change each month. So that's going to be the variable expenses. So both of them together we call operating expenses, but they're divided up into fixed expenses and variable expenses. Now, before tax cash flow is also something called cash on cash return that is used in the industry by some of the real estate brokerage companies, and a function of potential rents less vacancy, expenses, and debt service to reach an actual monetary return before taxes. And what this does, it takes your net operating income and then it subtracts your debt service, and whatever is left after that, that's your before tax cash flow. And a cash on cash return is the return the investor achieves on the equity that is invested by the investors. So it's calculated by dividing the before tax cash flow by the down payment, which is the money that the investor invested. So if you take that $10,867 before tax cash flow, divide it into $315,000, that's a 3.4% cash on cash return, which, depending on the market, it could be bad or it could be good. So it just depends on the time. And that's it. That's our real estate investment